Welcome back to Beyond the Benchmark. I'm Ryan Kasper. On this short holiday week, we saw a few key economic data points trickle in, including modest gains in retail sales and durable goods orders, higher producer price readings, decelerating home prices, and continued weakness in consumer confidence. Much of this data, though, still reflects older trends from before the government reopened, so investors are taking it with a grain of salt. Retail sales for September rose 0.2%, softer than expected, but still showing resilience in consumer spending. Gains were concentrated in health, personal care, and restaurants, while sporting goods and online sales pulled back after a strong back-to-school season. Year-over-year, retail sales are up just over 4%, meaning consumers are still spending at a pace that outpaces inflation. Durable goods orders were up 0.5%, driven by strength in capital goods and metals, reflecting continued investment in manufacturing and data center infrastructure tied to the AI build-out. Over the past year, durable goods are up 7%, with capital goods up over 13%, a sign that business spending remains solid. The Producer Price Index showed a 0.3% gain in September, matching expectations. Energy costs rose sharply, while capital equipment prices fell back. Headline PPI is running around 2.7% year-over-year, still elevated but not alarming, and core prices continue to cool. Housing data told a familiar story. The FHFA Home Price Index rose slightly for the third quarter, while the Case-Shiller 20-City Index showed a near-flat reading for September. Northern cities like Chicago, New York, and Boston led the gains, while Sunbelt markets like Tampa, Phoenix, and Dallas saw modest declines. Year-over-year, home prices are up around 1 to 2%, which means housing appreciation is now trailing inflation for the first time in years. Consumer confidence remains a weak spot. The Conference Board's index fell sharply in November to 88.7, near the lows of the year, as future expectations dropped and inflation worries stayed high. Interestingly, consumers continue to say they're worried, but their spending behavior suggests otherwise. Turning to markets, equities rallied last week, snapping the prior week's decline. The S&P 500 gained nearly 4%, and the Dow and Nasdaq both finished higher. Every sector posted gains, led by communications, consumer discretionary, and technology. AI was back in the headlines, this time with Google's announcement of a faster, more energy-efficient chip that could challenge NVIDIA's dominance in the space. International markets also joined the rally, with Europe, Japan, and emerging markets all finishing higher. Cooler inflation in Europe and a weaker dollar provided a nice tailwind. Bonds also fared well as yields declined across the Treasury curve. Investors took dovish comments from several Fed members as a signal that rate cuts could still be on the table in December or early 2026. Commodities followed suit, with gains across metals and energy. Gold and silver rose several percent, and crude oil climbed about 2% to $59 a barrel. So the takeaway this week, the market's tone remains positive heading into December. The Fed's language has softened, yields are easing, and investors appear ready to ride the final weeks of 2025 with a bit of cautious optimism. I'm Ryan Kasper. Thanks for tuning in to Beyond the Benchmark. Stay disciplined, stay informed, and we'll catch you next week.